tonight, the show is the Indian rupee, and it continues to hit a new record low against the US dollar. The currency has closed at 83.01 against the US dollar. And the dollar index continues to gain strength. It's risen around 12%. If you look at its growth trajectory in the last 6 months, the rupee on its part has lost 66 paise from its previous close. In fact, on the other hand, government bond yields have ended higher. And this as US yields have risen and a stronger dollar has pushed the rupee to its record low. Let's find out where this could be headed next. Lakshmi Iyer is President and CIO for Debt and Head of Products at Kotak Mahindra Asset Management Company. It's great to have you with us this evening, Lakshmi. But we're looking at this obvious fallout of a strong US dollar, where foreign portfolio investors, FPIs, are ditching emerging market equities for other options. I'm just wondering if you see this continuing for a longer time, or do you believe the dollar index has peaked out?
So, Vikram, this thought that the dollar as a currency has peaked out, has been doing rounds for quite some time. But the US Fed narrative that they will continue to hike rates as long as that is required to curb inflation, that whisper or that chatter doesn't just seem to stop. And that's also visible in the bond yields in the US. If you see, the 10-year bond yields are trading way above 4% mark. So all that gives you reasons to believe that there might be intermittent respites in the dollar rally. But trajectory-wise, unless the narrative of the Fed changes meaningfully and bulk discounting is not yet into the prices, the dollar supremacy is set to continue for some more time.
So then how do you see this affecting our markets between equity, debt and hybrid assets? How do you see the split in outflows at the moment? Is there a trend that would sustain over there that you're spotting?
So the current trend, if you look at it from an equity standpoint, whether it's year to date or it's month to date, the foreign portfolio investors or FPIs continue to be net sellers in equities. But if you look at the domestic investors, whether it's the institutions or the retail investors, they continue to be net buyers. Now, our sense is that that could be slightly more long-term or long-term allocations, especially from an India standpoint. And those allocations may continue. However, as we are observing, as the world markets are also getting cheaper, you could see some kind of a slowdown, which in the foreign capital flows, and that's what is leading to the net negative flows right now. So that trend might continue till such time there is stability on the currency, which does not seem to be the case right now.
And Lakshmi, what are your expectations of more aggressive monetary policy? Because that tightening by the Fed and other central banks, also to take into account crude oil prices, how are these going to determine the way foreign investors park their money in a possible risk-off approach that leads to more safe haven investments?
So certainly, I think it's not a dilemma for the central bank. Actually, it's a trilemma, because you are looking at a visibly appreciating dollar. You are looking at a reasonably benign commodity price, specifically crude. And of course, you are seeing strong headwinds on the global growth front, which will not completely spare India. So I think the rate hikes need to be calibrated, keeping this in mind. So the single stop solution does not seem to be right now that you aggressively hike rates, at least in India. But yes, the trajectory for rate hikes, can it continue? The answer is yes. And the RBI MPC minutes gave us reasonable peek into what the MPC team is actually thinking about this. So it does not seem to be a slam dunk that we are going to see the path of aggressive tightening continue. So probably one more rate hike as an insurance rate hike may be warranted. But as I said, growth also needs to be kept in mind right now.
Will that happen in India, Lakshmi? Because the strength of the Indian markets is something that many experts are pointing towards, and the kind of earnings reports that we have seen so far. Does that suggest any direction to you in terms of the strength that the Indian markets offer to foreign investors and beyond?
Vikram, the markets are clearly saved for earnings. And in so far, there has not been really, of course, we're too early into the result season, but it's not been a major disappointment yet. So maybe FY 2023 might be of slightly, maybe on a cumulative basis, Q3 and Q4 might portend something more drastic, if at all that has to happen, because we are seeing a lot of rate adjustments on the higher side on the balance sheets happening in this quarter and partly in the last month of the previous quarter. So unless this prolongs and sustains for a longer time, there won't be or there may not be material earnings cuts, and markets are clearly looking out for that. And of course, as you head closer towards December, markets actually start focusing on FY 2024. So I think these are some of the factors, and incremental inflows into the mutual funds. The month of September was one clear month of testimony to that. I think all of these factors also will continue to weigh in, apart from the fact that people are tracking valuations as well.
Thanks very much, Lakshmi. Always a pleasure getting your perspective. Thanks so much for joining us on this edition of India Tonight. Meanwhile,